on the market, since it seems to be maybe developing into information that I think we need to get out. So let's, again, talk about the Apple market for just a second. I want to be clear that every time people get suckered into buying the glamour stock of the day, there's always a very good reason why you should not sell it. And the very good reason why you should not sell Apple is it is cheap. And it's demonstrably cheaper than Cisco at 80 times earnings or anything. There's no argument about that. But it doesn't matter. What? What do you mean so? I don't know what I said that. I don't know if I got confused there. I'm sorry. Chris is correcting me. Yes, people are being told not to sell Apple because it's too cheap. That's what I meant to say. They've been saying, don't sell it. It's too cheap. It's a bargain. What I'm telling you is there's always a good reason why you should not sell the glamour stock, if I wasn't clear about that. And so now I had Chris do a little bit of research on it, and I have him talk about that right now as it relates to Apple.
Well, Mike and I were talking about Apple, who this year joined the $500 billion club, which, just to be clear, that's companies that have a market capitalization of $500 billion or more. Very quickly, market cap is just number of shares outstanding times their share price. So if it's worth, however much it's worth is how much the company is worth. So the $500 billion club, Apple became the 6th company to join that. They joined Cisco, Intel, General Electric, Microsoft, and ExxonMobil. Now, a couple of points that I'd just like to point out, which is, I think you guys might find interesting. Cisco hit the $500 billion club in March of 2000. Their current market cap is $89 billion. And just to be clear, I'm just going to round down to the nearest whole billion. So they went from 500 to $89 billion. Intel hit it in August of 2000. They're now at $103 billion. General Electric hit it also in August of 2000. They're $219 billion for their market cap. ExxonMobil was the last company to hit it, which was August of 2007. They're currently at $398 billion, the one still with the highest market cap. And then lastly, I want to point out Microsoft, because Microsoft and Apple, people seem to put them in the same conversation. And also, Apple and Microsoft are the only two to make it to $600 billion for their market cap. Microsoft hit it in December of 1999, and they're now at $237.5 billion. So, I'm not saying that, the past is indicative of what will happen in the future, but every single company that's hit it has receded. And that's interesting, and as investors, we should definitely take note of that. Now back to Mike.
Thanks, Chris. That's good. So let's go to the first chart. Not yet. There it is. Okay. So this is sort of a graphical depiction of what Chris just talked about, which is kind of fascinating. So Apple, then you have PetroChina, which was, again, really an attempt to just talk about the pricing of securities at another mania, which would have been the Chinese stock market. And then there's Microsoft. So again, let's go to the third chart actually quickly. So it's the third chart. Okay. There we go. Okay. So here's another interesting thing. Again, certainly Google and Apple are sort of similar in their businesses, but I tell you, none of that really matters. What happens with this parabolic move, we could show that where it showed, for Apple up to November of 2007, Google 2007 and Apple to present. What you're looking at is that last move up is the parabola move. It's the belief that it's the greatest thing since sliced bread. It's that there's no way you can lose any money. and then it's as the market is peaking as well. See, November 2007 was very close to the peak in the market for 08 and 09. I mean, it's really not that complicated. What happens? You get the one stock that you cannot lose money in, that you're sure you'll be able to participate in any market rally. Nothing can stop it. And, you know, so what happened to Apple recently is it went from couldn't get enough of it to I own too much of it. I'm going to have Chris send out the little part of the tape, but you can go to the beginning of my August 27th tape and you can see what I had to say about it then. I'm not trying to be a wizard. In fact, I say that. I'm just trying to say things I can't wiggle out of. I'm just trying to help people. So if I'm trying to help people, I'm not trying to give you some kind of silly prediction. We're trying to give you information that you can use to be a successful investor. And I think if you can use information that says when the market focuses on one major great idea stock, get the hell out of the way is what I'm trying to say. So the market has been weakening and was just waiting for Apple to decline. So there we have. So when I was always wondering, when would the weak economy, the weak sentiment in the market, the weak financial system, when would it create a tipping point for the market? Part of the problem that I want, again, to tell you and be clear about is don't pay attention to the media. They're always looking for an issue, as the election, QE, the election, the fiscal cliff, Europe, earnings. Well, the reality is the market was able to do exactly what it wanted to do based on the internal dynamics of the market through all of these various things. And it's the market itself and where we're positioned and how whether money feels like it's going to make money or it's going to lose money that is really the key determinant of what's going to go on right now. So I believe I have a great article which I'm going to try to I'm going to send out. I can't talk about it because we'll go too long, but it's making the point. It's from Minionville, and the article is Rally Off 2009 Lows Flushes the Hedge Fund Shorts. I think it's a tremendous analysis, sort of a technical analysis, but it's really an analysis that I feel comfortable with, not looking at charts as much as looking at behavior. And it was his opinion, the writer's opinion. Let me just get his name for just a second because I think it's only fair that I do that. Vince Foster, November 12th. He writes that he feels that the market's been moving up because the hedge funds have been wrong. They've been too negative. I've been too negative, I guess, obviously, because the market keeps going up. And many of the strategies I've been using are sort of hedge fund-like strategies, although I'm not as aggressive, not using leverage, just being long and short, being hedged. And so his view was they've been wrong, and now they ran in at the end of the year. Around 1,400 on the S&P, they ran in. They were up 5% for September, but still down for the year. And now he feels they're the ones that are going to get skewered. I see another thing that I think is terribly important, that I think is much more important than this short-term feeling about what the market's going to do, or again, the news. And I think it's powerful. Since the election, I've run into many very sort of, let's say, conservative, politically conservative investors. They're not conservative in how they invest in themselves, but they're politically conservative, and they're investors. They are exhibiting a powerful level of pessimism. Powerful level of pessimism. One I saw, he sold out all his stock. I think this is terribly important. This is a group that was convinced that Romney was going to win. And I think the 300-point decline in the market was that they were shocked that Obama actually won instead of Romney. This was shocking to them. So now they know definitely Obamacare is here to stay, definitely that their taxes are going to go up, particularly for their investments, and regulation is going to increase. So all of these things that they perceive as significant to them making business decisions and investment decisions have all gone negative. And I think that with the potential that tax rates could rise, they have an incentive to sell now. So them selling now is kind of, again, with the hedge funds getting caught, are two significant potential tipping points in the way the market actually works. Forget what's going on in the economy and the financial system for just a second, and look at how the market works. The market is in trouble. And the other thing that makes it difficult here is safety is overpriced. So what are people going to do? Leave stocks for bonds at the lowest rates ever? So we really have a very difficult situation. A guy on Bloomberg today said that, I think his name was Petrovsky, I hate to get his name wrong, but he was the guy that had from 3 to 5 o'clock. He was excellent. He said that the holy grail now is that you buy high single-digit returns with low volatility. Now think about it. That's what everybody's doing. And I say avoid the crowds. The mistake that people make in investing is that they do what everybody else does to too much of an extent. And you have to pay attention to whether that's over. So I think it's a particularly major problem. I feel what you should do is you should make volatility your friend. So don't go for low volatility. Make volatility your friend. And I think that the alternative strategy of long short is the best place that I can see going. So, rather than being negative, I think we're at a fascinating point in the market. Could be wrong. That's the reason why I'm saying what I'm saying. Like, I could have been wrong, and I was wrong August 27th. Apple went up another 50 points, but it's now down 100 points from when I said that. So what actually happened to the group of long-short funds that I follow last week? Well, one was down 0.5%. One was down, check and see what the S&P did last week. One was up 0.3%. One was up almost 0.5%. One a little bit more than 0.5%. One was up 1 and 0.7, and that's my biggest position. So I'm really glad that it had such a good week. And then one that's not exactly long short, the Husband Fund, which I've been using as a little bit more of a directional play, a little bit more of a negative play, was up 1.55%. This is all where the market was down 2.5-ish. Right, so it's down over 2.5%. Now, again, please, I'm not a short-term thinker. I'm not talking about the short term. But I'm trying to say is that if you're trying to develop a strategy, it's got to start to work when the circumstances in the marketplace are as you expect them to be. And I'm becoming convinced from what I saw, particularly with quality investors. In fact, this guy, Foster, says, in his opinion, or just somebody else's opinion, he believes that the entire move of the market from 2009, suspected the entire rally off the 2009 lows was a giant clearing out of the suckers trade. The mission of this market was to run as high as was needed to flush out the shorts. Now, that's a very interesting analysis because that certainly is what happened to me. In September of 2009, I looked at analogs from the Great Depression, so we had a 50% rally. I'm not going to go short the market. I'm not being aggressive, but I felt strongly in agreement with Jeremy Grantham that the spread between quality and junkie stocks was the widest since 1933. That has proved to be wrong so far. But when you are an investor, you can be patient. Investors can be patient because they're not taking excessive levels of risk. So again, let's see if this is correct. I will analyze it. I will pay attention to it. But I'm feeling pretty comfortable that we're now beginning to see that we're on the right track and that the advice can be taken any way you want. Number one, get out of the way. Number two, do not go into the bond market at the moment. That's not safety as far as I'm concerned. If everybody's there and the price is expensive and the math is negative, it's dangerous. So, okay, should I ask a question?
I just want to try to fix this.
Okay, go ahead, China.
Okay, one thing that I wanted to make perfectly clear for those of you that are on the call. This chart that we have is it's a little outdated because Apple actually, with the red line, if you follow me going up this way, went up to over $700 a share. I think they topped out somewhere in the neighborhood of $700, $705 a share, somewhere in that neighborhood. And now they've dropped down. And now they're back down closer to about $550, roughly speaking. So I want to make sure when you see this, it shows Apple riding up right along with Google. and then Google started to fall down right when the economy started to take a turn. Apple actually did go significantly higher, at least $100 a share higher than what we see on here right now. And now, for better or for worse, it started to come back down to earth. So I just wanted to make sure I pointed that out.
So are they muted or unmuted? Okay, so we will give people a chance to make a comment or have a question. I think, generally speaking, what we're hoping for is that people will go on and listen to it or send us an email with questions that they may have. But I still want to allow people an opportunity to make a comment. Thank you so much for your time.